Hi, all, good morning. So this is question 1, and what we have here is the filling out of the non-current asset register. And it is pretty straightforward, although there is the odd little sort of trick. But this, again, what I'm doing here is I will always try and relate this to the bigger theory as well, so just for good revision. So I'm sure you've read the question. Please read the question. What they're trying to do here is you're trying to record the purchase of a new asset. So, and also you're also trying to record the disposal of an asset. So they give you some information, and what you have here is the screen printer that you're picking up. Now, this chapter really is about a mixture of two chapters: filling in the non-current asset, but also a register, but also this discussion we talked about capital and revenue expenditure. So capital expenditure, asset, revenue expenditure, yearly. But not just that. Capital expenditure, we're talking about assets, if you like. And when we talk about assets, the definition of an asset is not just the cost of the asset, but all the costs that have had to be incurred to bring it to its place of working. Right? For us to be able to use the asset, if you like, we need to think about all the costs. And I've given examples before that if you buy a computer in Sweden and it costs you £1,000 to actually ferry it over to London, and it costs you 500, so you bought a computer in Sweden for £1,000, and then you needed to pay £300 to get it delivered to you, and you had £100 actually to get it set up. That's the full kind of capital cost, not just the £1,000. So in this question, the capital costs, of course, is the screen printer, and of course it says you need a floor stand, of course. Now this screen printing mesh, if you like, I mean, I can see how you might think, well, Owen, why isn't it included? Well, simply because it's mesh and it'll probably die, or it'll just decay, if you like, by the end of the year. It's not really, you don't need it to use the computer first of all that way, but I think really for me it's more the fact that it probably won't last more than the year. And I guess also thinking about it from an exam skill point of view, there is a likelihood that you'll try and put something in there that just does not fit into capital expenditure but feels more revenue expenditure. But remember, this is about the process, so even if you missed this one, we're now in exam mode. Don't worry about it, just carry on. So that's your capital expenditure. Yeah, so let's carry on. So now that you have that as your capital expenditure, remember that we don't include the VAT in that process. It says this VAT can be reclaimed. So you're just trying to include these net amounts. Don't forget that. Right, so let's look at the next screen, because I tried to capture these pictures. Not quite. So then you have this disposal. Right, then you have a disposal, so we now have it. And so, of course, again, something you want to watch out for, of course, is the year-end dates. Right, you want to be clear on what the year-end dates are. It's really important. Another thing that you also want to pick out is this question of a full year's depreciation is applied in the year of acquisition. So we will depreciate in the year of acquisition and none in the year of disposal. So for this disposal, there will be no depreciation. No depreciation for this disposal. Right? So you're getting rid of a printer, and it says that you sell it on the 31st of July, so in that year there is no depreciation. Okay, and you got 1,750 for it. So that's what we're going to record in the non-current asset register. And then let's go to the non-current asset. So they give you this table. I mean, I don't have the top there, but looking at your question, I'm sure you can see that you have the date and the costs and the depreciation and the net book value and how you dispose of it. And how you are paying for it. And they give you these things. So here you, of course, have this, here, of course, you have the screen printer and the stand, of course, and you have the date when you buy that thing. And then, of course, you have how much you paid for it, which is the combination of the 4950 plus the 596, right? Let's just go back and look at that. There you are, 4950 and the 596, because those are the two things that you're paying for. This is revenue expenditure. Okay, Right, and let's go back here. So you have those two things together. Then they give you the process of depreciation. They tell you to depreciate over 8 years. So they tell you, oh, depreciate over 8 years, a straight line. So that's simply dividing this by 8. And they're giving you 2 decimal places. So divide this by 8. We'll look at the answers in a second. And then you get your depreciation. And of course you get your your carrying value, your net book value by deducting this from this. And you get your answer over here. I think in the question they tell you how you actually buy this thing. Let's just look over here. It says that you part exchange, hire purchase agreement. So I suspect you will find that answer there. Oh, sorry. This is yes, task 1. Yes, by you pay for this by hire purchase. So you don't pay cash, so you will have that option as well. All right, then let's look at the disposal very quickly, and then you'll see that the disposal. You have the column here. You're disposing of this printer. Well, like we said, in the year of disposal, there is no depreciation. Right? There is no depreciation in the year of the disposal, but you have, if you like, the headings over there for the amounts and the date at which you dispose. I think you disposed this thing for 1750, and I think you received check probably or cash. You can look at that. You can actually find out what's going on there, right? And then let's look at the motor vehicles. Nothing seems to happen in terms of the motor vehicles in terms of acquisitions or disposals. So they tell you that this is I believe, a 25% reducing balance method. So reducing balance method, we're focused on the carrying amount. So you take 25% of this thing here, 25% of the 5310.36, put that depreciation figure in there and deduct that depreciation from, if you like, from this carrying amount. Sorry about that. And then we do exactly the same thing here. So 25%, I mean, you have, if you like, that's the depreciation in the first year, then you have the carrying amount, and 25% of this, so you take 25% of this, put that 25% there, and then you have the carrying amount again by deducting this from this, right? So let's look at the answers very quickly. I think I have the answers here. Right. Oops. Okay, let me try and make this bigger. Okay. Okay, great. So you can see everything I've been talking about. What do we have here? There's no depreciation in that year. That's the disposal amount. That's the date you dispose of it. It tells you to give you hire purchase. Those are the two figures I added together, right? The 4950 and the 596. And then you can see that you depreciate it over 8 years. Put your figures in there. And then what do we have here? Then we have this thing I was talking about. Oops, sorry. Let's go here. Then we have these two things I was talking about. So we have the depreciation on the carrying amount of 1327 on that carrying amount, and then we deduct this from this, of course, and we get this. And then if we go to the motor vehicles, we have this van, like the motor vehicle here. We do exactly the same thing again. We take 25% of that, and then we deduct that from that, and we're there, right? And so the last question says, the last question asks you, let me get this right. Let's drag it. Yeah, the last question says, which describes the residual value means scrap value, really. Right, residual. Remember, I talked about this question of the life. We can only include the life of the asset within our income statement. So if you buy something for £10,000 and someone tells you the residual value is £1,000, you can only include 9,000 of that value in your business. You're not going to use this other 1,000. It's not coming into your income statement. This is the accruals concept. Only include the 9. And so really it is what probably is the expected market value, or what we can sell it for, really the scrap proceeds of this. And so it's probably it is this one. The difference between the carrying amount and the estimated scrap is the life of the asset. So it's not this one, the original cost. No, it's not this one. Less depreciation. So this is the carrying amount, And be careful for these definitions, carrying amount plus accumulated. I don't even, carrying amount plus, I'm not even sure what this even means. There's no meaning here. Okay, great stuff. So that's question 1.